Hello, welcome to the Grow Your Wealthy Mindset podcast, where it is all about helping amazing physicians just like you create a wealthy life free from burnout and with the financial security to practice medicine on your own terms. I'm your host, Dr. Elisa Chiang. Welcome back to another episode of the Grow Your Wealthy Mindset podcast. You probably have all heard of Social Security and know something about Social Security, especially that we see that money is taken out of our paychecks to go to Social Security. But how much do we really know about our Social Security benefits or how it actually works? Our Social Security number has been an identification number that's used probably for what is much wider than the range that was thought to be when Social Security was first created. Social Security cards are still used as a means of identification, and yet they are just flimsy blue pieces of paper. In this episode of the Grow Your Wealthy Mindset podcast, I'm going to go a little deeper into the Social Security program, how it came to be, and whether you or I can expect to actually get any Social Security benefits in the future. Social Security is a term used for the Old Age Survivors and Disability Insurance, OASDI, program in the United States. It's run by the Social Security Administration, which is a federal agency. It's best known for retirement benefits, but also provides disability and survivorship benefits. Social Security is funded primarily through payroll taxes called Federal Income Contributions Act, or FICA, F-I-C-A, or Self-Employed Contributions Act, SECA. The tax is levied on both employees and employers who currently pay 6.2% of gross wages up to a certain income threshold for a total of 12.4%. If you're self-employed, you have to pay both the employer contribution as well as the employee contribution, so you're paying the full 12.4%, which is commonly referred to as self-employment tax. However, self-employed individuals can deduct half of their self-employment tax when calculating their adjusted gross income for income tax purposes. Social Security tax is only applied to income up to a certain limit, known as the Social Security wage base. The limit is adjusted annually for inflation based on the National Average Wage Index, and in 2023, the maximum amount of taxable earnings was $160,200. This is why you may notice a little bump in your paycheck once you've hit a gross income past the $160,000 mark. The Social Security system in the United States came into existence on August 14, 1935, when President Franklin D. Roosevelt signed the Social Security Act into law. The first monthly benefit checks became payable on January 1, 1940, and Ida M. Fuller, a retired legal secretary in Vermont, was the very first person to collect from a Social Security check for an amount of $22.54. There have been a lot of changes in the Social Security system since 1935. Currently, Social Security is one of the largest government programs in the world, paying out hundreds of billions of dollars a year. The total cost of the Social Security program in 2022 was $1.244 trillion US, which is about 5.2% of the United States GDP. Approximately 94% of employed people in the United States do pay into Social Security. There are about 6.6 million state and local government workers in the United States, or 28% of all state and local workers who are not covered by Social Security, but rather by pension plans that are operated at either the state or local level. This includes people working for public schools as well as county hospitals. The average monthly Social Security benefit for September 2023 was $1,706, which is $20,472 a year. Most physicians or high earners will be eligible to receive about double that amount, which we'll go into details in just a little bit. How does Social Security work? Social Security is, in essence, an insurance program. Workers pay into the program, typically through payroll withholding where they work. Self-employed workers pay Social Security taxes when they file their federal tax returns. Social Security payroll taxes are collected by the Internal Revenue Service, the IRS, and are formally entrusted to the Federal Old Age and Survivors Insurance, OASI, Trust Fund, and the Federal Disability Insurance, DI, Trust Fund. These are the two Social Security trust funds. These two funds are used to pay benefits to people who are currently eligible for them. The money that's not spent remains in the trust funds. A board of trustees oversees the financial operation of these two Social Security trust funds. 4 of the 6 members are the secretaries of the Departments of Treasury, the Department of Labor, the Department of Health and Human Services, and the Commissioner of Social Security. The remaining 2 members are public representatives appointed by the president and confirmed by the Senate. Social Security pays benefits for retirement and disability, and payment may go to the individual who's qualified through Social Security, or benefits may be paid to select family members. For example, a person who has never worked may receive benefits through their spouse or even their divorced spouse if their spouse qualified for Social Security benefits. There are a broad range of people who may qualify for survivor benefits, and that includes widows or widowers, surviving divorced spouses, disabled widows or widowers, disabled surviving divorced spouses, orphans, and widows or widowers that are caring for minor or disabled children. Each category has different requirements for qualifying for benefits, and I'm not going to go into every single category's qualifications. Speaking of qualifying for Social Security benefits, let's start with how to qualify for retirement benefits. In order to be eligible for retirement benefits from Social Security, you must have earned at least 40 credits. Workers can earn up to 4 credits each year, which means a person needs to work a minimum of 10 years to be entitled to Social Security retirement benefits. These years do not have to be continuous. For every $1,640 earned in 2023, 1 credit was granted, up to $6,560, where 4 credits can be achieved. For 2024, the amounts are $1,730 per credit and $6,920 to receive the maximum of the 4 credits. Early retirement benefits from Social Security can start at age 62 or can be deferred until later. The later Social Security retirement benefits are deferred, the higher the benefits that are paid, up until waiting to age 70. Benefits don't continue to increase past age 70. While some individuals will qualify for more than one type of benefit, the program generally has rules to prevent the payment of 2 full benefits. For example, a person eligible for a retirement benefit and has a spouse who qualifies for a higher spousal benefit could receive a full retirement benefit and a partial spouse benefit, but wouldn't receive their full retirement benefit as well as a full spousal benefit. As you can imagine, the dual entitlement rules disproportionately affect women who have historically earned less than their current or former husbands, and this leads to retirement benefits for women that are often lower than the full spouse benefit for which they qualify. The spousal benefit claimed at full retirement age is 50% of the spouse's benefit. If claimed earlier than full retirement age, then it's less, but unlike claiming one's own retirement benefit, there's no benefit into waiting past full retirement age to claim a spousal benefit. In order to claim a survivor benefit, the survivor must be at least age 60 and not be remarried. If you are divorced, your marriage lasted at least 10 years, and you haven't remarried, you can also receive a benefit based on your prior spouse's benefits. Depending on the situation, it could be beneficial for some to stay married for 10 years in order to claim these benefits. Children of retirees can also receive benefits until they turn age 18, or even longer if the child is disabled or a student. That cutoff age is lowered to age 16 if it's a child that's being cared for who's not your own child. How much you can get as your Social Security benefit depends on your average index monthly earnings, or AIME, during your 35 highest earning years, so amounts will differ significantly among retirees. The average monthly benefit as of September 2023 from Social Security is $1,841 or $22,092 annually. Many physicians paying into Social Security will have paid the max amount taxed each year, which means being entitled to a maximum monthly benefit. If you elect for early retirement at age 62, then the maximum monthly benefit is $2,710 a month, or $32,520 annually for 2024. If you wait until age 70, then the maximum monthly benefit is $4,873 or $58,476 a year for 2024. There's also a yearly cost of living adjustment made to Social Security benefits to keep up with the pace of inflation. This was 8.7% for 2023 and 3.2% for 2024. I know personally that I haven't given a lot of thought to Social Security because realistically, before researching this episode, I didn't think it would still be around by the time I actually got to retirement age as defined by Social Security. So what are the chances that you'll actually receive the retirement benefits that you're entitled to, that we've been paying into for so long? The revenue that Social Security generated actually exceeded the amount they had to pay out between 1983 and 2009. So that actually increased the trust fund balances. The retirement of the large baby boom generation, however, will lower balances. If there aren't any changes to legislation, then the trust funds are projected to be depleted in 2033 for the OASI fund. At the point of depletion, the incoming payroll tax and other revenue would still actually be able to pay 77% of benefits starting in 2035, and that would continue indefinitely. Which means that it actually is likely that Social Security will contribute to some extent to your income during your golden years. While Social Security is certainly not enough to fund your entire retirement, it still may provide a non-trivial amount, and it's worth at least learning about the program, which is why I decided to put together this episode. If you live long enough, you will have to make some decisions regarding Social Security at some point, and it is worthwhile to make an educated decision. A few nuances that pertain to Social Security. Full retirement age is the age that depends on the year that you were born. If you were born between 1943 and 1954, then full retirement age is 66. If you were born between 1955 and 1959, then full retirement age falls somewhere between age 66 and 67. For example, it could be something like 66 years and 4 months. Currently, if you were born in 1960 or later, full retirement age is at age 67. For the rest of this episode, I'm just going to assume everyone listening was born after 1960. If you were born before 1960, hopefully you've already looked into how Social Security works because you actually could potentially file for benefits at the current time. The primary insurance amount, or PIA, is the monthly amount of your retirement benefit if you claim the retirement benefit at full retirement age, which again, I'm going to assume is age 67 for people listening to this podcast. This primary insurance amount is based on that AIME, that average index monthly earnings that I mentioned earlier. Calculating your AIME can be a bit complicated. Essentially, to calculate your AIME, you would list out your income up to the max limit for each year and then adjust for inflation. Then select the 35 highest earning years, total up all these earnings, and divide by 420 to get your average of your 35 highest earning years. If you haven't worked 35 years at the maximum limit, then you may wonder how much does one more year of maximum earnings add towards your retirement benefit? After all, most physicians I know these days don't plan on working for 35 years. For each of the first 3 years of maximum taxable earnings, there is a $3,302 increase. For each of the next 17.5 years of maximum taxable earnings, there is a $1,174 increase. For each year beyond that, up to 35 years, the increase is only $550. So basically, having 20 to 21 years of maximum earnings is the sweet spot to aim for, with each additional year adding less benefit. When it actually comes to calculating out your AIME, I wouldn't recommend actually trying to do it yourself. Social Security will do this for you, and you can find out by just looking at your Social Security statements. You can start claiming Social Security retirement benefits as early as age 62, but by electing to get these benefits early, you will get paid less. At age 62, you receive 70% of what you would receive if you wait for that full retirement age of 67. At age 63, you get 75%. At age 64, you would get 80%, and so on. The longer you wait, the higher the monthly benefit. And the benefit continues to increase if you wait to take benefits later than full retirement age, up to age 70, where it maxes out at 124% of your PIA. So how do you decide when you should start taking benefits? Let's compare two unmarried people. Eager Emily, who files for benefits at age 62, and patient Patty, who waits to age 70 before she files. If both Emily and Patty live to age 70 and die, then of course Emily will have gotten a lot more from Social Security benefits since Patty never collected on any benefits. The age where Emily and Patty will have gotten the same amount of Social Security benefits paid to them, that break-even point, is at age 80.5 years. Beyond that, patient Patty will receive more benefits compared to eager Emily. If you've already reached age 62, then your life expectancy is around age 83, which is above 80.5 years. With a higher income, you'll also likely have a higher life expectancy compared to the general population. This is because people with higher incomes tend to live in safer neighborhoods, drive safer cars, can afford healthier food, as well as afford better healthcare. I think it's safe to say that the life expectancy for most physicians is longer than life expectancy of the average person in the United States. You also need to take into consideration that money is more valuable sooner than later. That's because you can invest the money you receive earlier and have potentially more returns than if you waited later. So if eager Emily invests all the money she received by starting to take benefits at age 62, then it would actually take longer for patient Patty to catch up when she starts taking benefits at age 70. For an inflation-adjusted return of 1%, that break-even age is around age 82. At 2%, that's around age 84. If Emily had an inflation-adjusted return of 5%, then that breakdown age is actually closer to 90. Of course, to get that higher rate of return, you would need to invest in a vehicle that's a higher risk than waiting to collect on Social Security. To truly compare the difference between taking Social Security benefit early and investing it versus waiting to take Social Security, you'd want to compare investing those early Social Security benefits that you're taking to an investment that's at the same risk level as Social Security. Investing in Treasury inflation-protected securities, also known as TIPS, meets that criteria, since Social Security benefits are also increased with inflation. As of May 2024, the yield on a 10-year TIP is 2.15%. So that gives a break-even age of around age 84, which is the average life expectancy of the average person who has reached age 62. And that's with the current relatively high interest rates. Since, again, physicians would be expected to have a higher life expectancy, it's likely most beneficial to wait to age 70 before you start taking Social Security benefits. Delaying taking Social Security benefits also reduces another risk. The financial scary scenario for retirement is living for a very long time and running out of money. Delaying benefits works great when you live for a long time because you're getting paid until you die. So the longer you live, the more benefits you obtain, and the longer you wait, the more benefits you're getting per year. For most physicians with normal life expectancy, such that they would likely live past that break-even point of 84 years, it's really a good idea to wait to age 70 before taking retirement benefits from Social Security. Good reasons to claim early are basically you really need the money earlier due to not having other savings for retirement or not having enough savings, and so you actually need the extra money from the Social Security benefit, or that you have a shorter than average life expectancy because of something like having a medical condition that will limit your lifespan. If you're married, then the spouse with the higher PIA should delay taking retirement benefits until age 70. The lower PIA spouse only increases monthly benefit while both people in the couple are still alive, which means now you have to look at joint life expectancy. This can be a little harder to figure out, but it can be less advantageous to wait to take benefits, and the lower PIA spouse may want to start taking benefits as early as age 62 when they qualify. If you lose your spouse, you can file for survival benefits at age 60 and then file for your own retirement benefits at age 70. And of course, the program could change between now and when you come close to full retirement age, or the age where you can start collecting on benefits. After all, we know that the program will change in 2034 because that's when benefits paid are set to be reduced to 77%. The best we can do is plan based on how the system works right now, stay informed, and as you approach retirement age, adjust your plans when changes in the system occur. There's a lot more that could be said about Social Security, but since it can all change, I think that's a pretty good summary of what to know now, assuming that you're still years away from being able to collect from Social Security for retirement purposes. One of the benefits in hosting this podcast is that it gives me incentive to learn more about financial topics that I'm less knowledgeable about. I certainly learned more about the Social Security program in preparing for this podcast episode. I hope that the time I spend summarizing the important points of these financial topics is of value to you. If you enjoy listening to the Grow Your Wealthy Mindset podcast, let other people know about the podcast. Please help me reach more people. It's what gives me the incentive to keep going and producing these episodes. Thank you so much for taking the time to listen to the Grow Your Wealthy Mindset podcast. See you next week. If you enjoyed this episode, I would love it if you could share it with your friends and colleagues. And now for the disclaimer. I am not a certified financial planner, accountant, or attorney, and nothing I say should be construed as professional investment, tax, or legal advice. This show is primarily for your education and entertainment. I am a physician, but I'm probably not your physician. So if you need any medical advice, please contact your own physician. Thank you.